Good afternoon, ladies and gentlemen. My name is Paul Duran, and on behalf of the entire team at ELCO Management, thank you for joining us today. Over the last 20 years, ELCO has been providing our clients with niche, separately managed account investment strategies managed by experts in their respective fields. We have structured these investment strategies around energy infrastructure, regional banks, water infrastructure, and our latest life sciences. We believe there exists a growing need for innovation and investment in the life science and healthcare industries. This is especially true as the pandemic forged a new paradigm where pharmaceutical and diagnostic companies streamline speed to market for critical drugs, vaccines, and diagnostics. With that said, I would like to introduce Dr. Mark Charst of Life Science Fund Management, our sub-advisor for our new Life Sciences SMA. If any questions should arise during the presentation, I would ask that you please use the Q&A tab at the bottom of the page. Mark?
Thank you, Paul, and appreciate everybody joining us today. So what I'd like to do is give a little bit of an overview of Life Sci Fund Management, our platform, our capabilities, how we think about managing portfolios, and get to hopefully most of your questions about the SMA, how it's set up, and how we plan to put together the portfolio. So in brief, Life Sci Fund Management, think of us as a fundamental thesis-driven life sciences investor. And we focus on three major areas. And those are disruptive life sciences innovators, and I'll talk more about these as we go through, robust revenue and cash flow growth businesses, so commercial stage life sciences innovators that have sort of moved on to, entering the markets and, really generating, revenue and profits, and capital markets activity, which is key to the lifeblood of the innovation ecosystem that drives new therapeutics that are being developed. So from an executive summary perspective, I think it's worthwhile stepping back and talking about where the life sciences sector fits into other sectors and how investing in it is a little bit different. So one thing I like to tell folks is unlike FANG stocks or other major market segments, it's really much the case that it's not obvious what the best risk reward opportunities in the life sciences are at any given time. Try to ask any financial advisor or even biotech specialized portfolio managers, what are the 10, 15, 20 best biotech companies at any given time? It's a difficult question to answer. And that's because, the fundamentals matter in life sciences. So in the healthcare space, only products that provide clear and tangible value to patients, physicians, and the payers are going to be used and generate meaningful revenue. So you have multiple stakeholders that have rigorous scientific and medical guideposts that will determine their willingness and ability to use these products. And so figuring out those fundamentals of those products is actually a tough job, and it requires a lot of I think deep insights into the scientific technical complexity, the regulatory landscape, manufacturing, intellectual property, et cetera. All the fundamentals here matter, and they ultimately define the value of these programs as they move forward. And such, as you translate to what that means for investing in the sector, that passive buy and hold often doesn't work, particularly for disruptive innovators, right? A lot of these companies have binary outcomes. Either they have a differentiated product or they don't. The ones that do, are fantastic investments and have great returns. The ones that don't, typically destroy all the equity value. So, it's not like owning, the top 10 companies in the S&P 500 that are generating revenue and compounding returns here, right? There's binary outcomes here, and these portfolios, in our view, are best actively managed. And so, this is kind of where we come in, right? We really believe that a fundamental, actively managed, thesis-driven portfolio, leveraging the deep domain expertise that we have, is really the way to manage capital and portfolios in this sector. So let me talk a little bit about how this offering sits with our other offerings. So Life Sci Fund Management launched the Alpha-Centric Life Sci Healthcare Fund in November of 2019. We just crossed our 3-year track record. I'll talk more about that at the end. But just from a high-level snapshot, think of this as a 50-stock long-only portfolio that can participate to some limited degree in capital markets activity. Generally focuses on SMID to large cap companies, no leverage, pretty vanilla, just the equity. Okay. The ELCO Life Sciences SMA that we're discussing primarily today, think of this as sort of a best ideas version of what the mutual fund portfolio looks like. So it's going to be a 25 to 30 stock portfolio. Again, because of the structure, no capital markets participation, but we're going to be mindful of capital markets activity of the holdings in the portfolio. So no private securities or highly liquid securities, generally going to limit the micro caps for sure. And no leverage. Again, it's going to be vanilla equity, but a little more concentrated in the number of names. And a lot of you that know us also know that we are in the process of launching a full hedge fund version of our work, which will be long, short, can use leverage, all the bells and whistles. So I just want to juxtapose these different offerings together. But again, today the focus here is on the SMA, which we're very excited about launching with ELCO. So just very briefly on my background. I'm a scientist by training. I have a PhD in chemistry and chemical biology. I started out my career working in drug discovery and development. I think I'm one of the very few or only portfolio managers. It's actually a co-inventor of an FDA-approved therapeutic. Was very fortunate to have been part of a team, actually multiple teams that put a couple of different drugs in the clinic. One of which fortunately got over the goal line is currently helping patients. And I bring sort of this background to every investment that we make. So, again, it's rolling up our sleeves, looking at the basic science, looking at the fundamentals, and really trying to understand from a ground up, how these companies work, how these products work, and where they might fit into, meeting a critical unmet medical need. So I'd like to spend a moment on the LifeSci platform and give you a little bit of an introduction, because I think, this is a great point of leverage for our fund, and I think helps differentiate our capabilities on the research side for sure. So LifeSci Partners is a global provider of strategic scientific consulting, established in 2009, and I go back. One of the founders of LifeSci and I worked at a hedge fund together back before the financial crisis. So I go way back with before even LifeSci existed with the founder, and had been looking for an opportunity to partner with them to create a fund management business for some time, and that's where LifeSci Fund Management came from. I'm a co-founder of LifeSci Fund Management along with the founders of LifeSci Partners. So there are multiple vertical businesses on the LifeSci Partners platform that all focus in the life sciences ecosystem. So there's a investment banking group, there's a venture portfolio, there's investor communications, investor relations, public relations business. There's a partnering and analytics group that helps on strategy development side. Hundreds of employees, hundreds of corporate clients. I'll go through on the next slide. There's a global footprint. So here are the offices around the globe. And just to give you some metrics, just to give you a little flavor, for the sort of the reach and the breadth of the LifeSci platform. So there's a 12-member research team that is publishing over 500 analyst notes annually, and they're hosting events, in-person events. They're back to doing that now, which is great. At really all the major medical meetings around the globe, which is just a phenomenal resource to have a LifeSci analyst in the room with the thought leaders in almost every niche of drug discovery and development, hosting live events, gathering insights, hearing about what are the nuanced interpretations of the latest breakthrough medical data. This is hugely valuable, and I spend a lot of time with this research team. I do a once monthly call with the whole team, and we're able to really share ideas and talk about insights. It's a very valuable resource. And just to give a little sense for LifeSci, so back in 2020, the firm as a whole hosted more than 8,000 corporate meetings, over 160 thought leader events, and did a bunch of executive and board placements. So I think hopefully this will give you a little flavor for the platform itself, and just to simply state it, a big part of my job is to work to interact with some of the thought leaders on the LifeSci platform, curate those insights, and translate them into an investable portfolio. So I'm going to talk about the two major thematic areas of investment focus for what's going to be the ELCO Life Sciences SMA offering. And I carved out the capital markets participation because I mentioned that the SMA will not own illiquid securities, but again, we're very mindful of the capital markets activity of these companies. But let me talk about these two, because I think that they're complementary, and I think it highlights how our portfolio and our management style is a little different than a lot of folks that do this. So as you can imagine, based on our backgrounds, is that investing in disruptive life sciences innovators is a cornerstone of the portfolios that we manage. And really what we're looking for are science-driven companies that are really developing the revolutionary treatments. We're looking for the big breakthroughs. We're looking for the drugs and biologics and other medical products that really transform patients' lives. And so really we're given priority for what we like to call first or best in class products with new mechanisms of action, right? These aren't me too drugs, they're not incremental improvements. We're really looking for step changes in innovation, and that are highly differentiated from existing treatments, and that they're really the breakthrough type therapies. And so we're looking for, as well, from the corporate side, strong balance sheets, right? Good fundamental valuations, right? We're avoiding the really expensive companies, certainly that can get you in trouble on the downside, or that might offer poor risk reward. So we're not just blindly following the science here. We're also grounding our views based on where these assets might be valued at a given time, and thinking about ultimately the risk reward and their ability to generate returns. And maybe after we wrap up the introductory comments, I'll go through a couple of examples. I'm going to highlight Sierra in particular after we wrap up the general comments. And so juxtaposed with this in the portfolio is what we like to call robust cash flow and revenue growth companies. So these are, most of them were disruptive innovators that have now crossed into the commercialization realm, and we're looking for what are the best growing products that aren't already fully priced. Really simply put, that's what we're looking for. We think it's critical for a life sciences portfolio manager to pay attention to the commercial products, and these can include large caps as well, right? I don't have a market cap limitation in mind when I'm looking at the commercial landscape, because I find that over time even large revenue streams can be overly discounted. And we'll talk about an example, Horizon Therapeutics. We're going to talk about that one again at the end when I go through a few examples. But we think it's critically important, one, because it's a great source of alpha and upside for investment portfolios; two, because it helps limit downside in difficult markets, as the one we've been in for a couple of years in biotech. Again, I'll talk more about that in detail towards the end. And three, it keeps you grounded in thinking about what disruptive innovators might be valued at and what they might be worth, right? If you're constantly keeping your finger on the pulse of how the commercial products are performing, you get a sense for what's a discounted cash flow valuation for an asset, and it helps you be more realistic about setting price targets and understanding the risk reward for the development stage companies. And I guess the last point, that any biotech or life sciences portfolio manager focuses on is M&A. It's a big part of the landscape. It's a great source of alpha. It's something that we think is going to accelerate as we look forward. And we find that if a portfolio is more heavily weighted towards the most differentiated development stage and commercial assets, the M&A sort of takes care of itself, and you tend to get more acquisitions out of your portfolio if you're really lining up the fundamentals with your investing. And so, just to touch a little bit on the investment process here, we try to put a screen across a pretty broad universe. So we're really following, at a high level at least, more than 500 companies that have in excess of $1 trillion of aggregate market cap. So this is sort of our hunting ground, if you will. And we triage based on looking at some scientific fundamentals, and as well as some financial metrics. So we have some rough screens that get us looking at a more digestible segment of the universe. And then we're using our sector diligence and really, key opinion leader feedback. Again, this is where the LifeSci platform can be, very, very useful, is, understanding, nuanced insights from thought leaders who are on the front lines of developing these medicines and discovering them, can really help us, at the margin, differentiate between, what might be more interesting or less. And we sort of build out some thematic areas of focus, again, in sharpening our pencils on the financial side here. And then, from that shorter list, we're able to do more comprehensive diligence, interview management teams, really roll up our sleeves and look at the primary literature that's underpinning the products that are in development, look at the competitive landscape more carefully, understand the regulatory landscape, do some market sizing, et cetera. So, this is reserved for, this distilled down list of thematic areas that are of most interest at any given time. And then from the portfolio perspective, relative risk reward is guiding position sizing. I talk about this a lot, right? We pay attention to, where these assets are trading. I think folks that invest in the life sciences understand that the standard deviation of return for life sciences portfolios is the highest among any industry segment in the publicly traded capital market, or it's publicly traded markets, period. And you have to kind of be disciplined about entry and exit points. It's one of the harder things to do. You can get really enamored by a new molecular target and, really exciting science behind it, but you also have to be, a little bit, realistic about what valuation you should be willing to pay for that, certainly if it's in an early stage. And then, there's this sort of ongoing contact with management and key opinion leader community to continually validate a thesis, right? As these companies move, through the stages of development, more data is generated, and you have to make sure the thesis remains intact, because, as more data is generated, you could either validate or refute your underlying thesis. And again, you got to be pragmatic about, what the data is telling you and follow the data. Because again, going back to where we started, the fundamentals really do matter, and they will ultimately determine, the value of these products that are being brought forward. And then on the risk management side, which is critical in a bear market environment, we've been in a bear market in biotech for 2 years, and I'll talk more about this in a moment. But you really have to monitor, the progress of the companies very carefully. You got to monitor, for the development stage companies, the balance sheet and sort of the cash runway that the companies have, and what additional financing might look like, what the terms might be. So understanding the capital markets activity that's likely to come, and how that is compared to the development milestones, right? Do they have enough cash basically to get through that major clinical outcome that's coming next year or not? If they don't, there's a big financing overhang, and you got to think about how to manage that, or how to manage your exposure around that event. And also, following these companies and understanding, when when they're being drawn down for fundamental reasons or not. Because again, this high standard deviation of return for each single stock, really can often provide attractive entry or exit points. And so having a, fundamental driven price targets and, also exposure limits, can really help, create and capture alpha, based on just, some of the non-fundamental movements that these stocks can undertake at times. And I think that, in aggregate, the other big part of risk management is what I alluded to, talking about the thematic areas of investment, and that is stock selection, right? So, obviously in a bear market environment, having more commercial stage companies whose valuations have an underpinning based on real cash flow or earnings, can really help buffer a portfolio's downside. And so, we match the composition of the portfolio based on the market environment. And so, I'll talk more about this in a moment, but, for example, in 2020, right, the mutual fund was mostly development stage companies. The second half of 2020, that was an exuberant period for biotech, a lot of exciting things happening. There was a lot of capital flowing into the sector. The music was on, it was time to dance. Compare that to what's happening in this current environment that we're in, this past year. It's been time for commercial companies, right? They're performing well. even in a raising interest rate environment. And, they have, intact fundamentals. And so they've performed pretty well, more robust commercial stage companies, whereas the earlier stage ones have faltered. So, the portfolio is actually majority commercial stage companies at this time, at least the mutual fund portfolio. So that gives you a little flavor for, risk management in terms of, stock selection and individual exposure limitations as well. So maybe with that, I have some obligatory risk disclosures here. I'll pause here and Paul, if you have any questions, or if there's any questions from the audience just about the general strategy, I'm happy to address them here, and then we can move on to some, some detailed analysis of what's happening in the sector and some individual stock ideas.
No, thank you, Mark. I really appreciate that overview. Well done. I hope everyone shares our excitement over this new product and having Mark management manage it. We are very excited about the prospects going forward. Again, if anyone does have any questions, please use the Q&A tab at the bottom of the screen.